Welcome to the October episode of First Look ETF. I'm Ron DeLegge with ETF Guide, and it's great to have all of you with us. Coming up on today's program, although stock market volatility has been muted for most of 2024, it's still a big concern for some financial advisors and investors. We'll tell you about one recently launched ETF that aims to diffuse volatility. Plus, we'll examine ETFs linked to an exciting area of the stock market, specifically growth companies, which are driven by innovative products, cutting-edge technology, and revolutionary business models with high risk, but also potential for high returns. To kick things off, we've got Maital Legum with the New York Stock Exchange joining us. Maital, thank you for being here. Great to see you again.
Great to see you as well. Excited for another episode.
Yeah, me too. So let's get started with just giving us the latest ETF launch update and activity at the New York Stock Exchange.
Sure. So September has by far been the busiest month in terms of launches in the history in the U.S. We saw 125 new launches come to market, shattering the previous record of 71, which we only hit last year. So for those of us keeping track of things, that brings us to a total of 3,766 listed ETFs in the U.S. at the end of September, with over 10 trillion in asset under management, another record and all-time high for our industry.
Yeah, pretty impressive. And it seems like the ETF industry just keeps making and hitting one record after the next. And as you alluded to there, U.S. listed ETFs have reached a significant milestone in September, crossing above that $10 trillion mark in assets under management for the first time ever. That's an impressive feat. So what is behind the asset boom in ETFs?
So yes, the U.S. ETF industry reached over 10 trillion in September, which is an amazing milestone, but there doesn't seem to be any slowing down. With domestic equity ETFs accounting for close to 80% of total ETF assets and a strong tailwind in the U.S. market, up more than 20% this year, we saw the numbers soar. We also saw strong net cash flow of $800 billion this year, potentially putting us on track for a record year.
What other ETF trends are you monitoring?
2024 continues to be the year of the active ETFs, with over 3/4 of new launches this year being actively managed. As the industry eagerly waits for movement in the multi-share class proposals, which will allow asset managers to create new classes of ETFs of their existing mutual funds, many are still selecting to create standalone ETFs and conversions to capture the increased demand in the investment solution in an ETF wrapper. New ETF launches in 2024 have also continued to be dominated by buffered and income-producing ETFs. With more choices than ever, we continue to focus on making access to information easily available for all. So go to etfcentral.com and catch up on the latest ETF news and trends and all things here happening at the NYSE, the home of ETFs.
Well, thank you, Maital, for that excellent update, and keep up the good work. We'll catch up with you soon.
All right, thank you.
Just a quick reminder to watch First Look ETF on Apple TV, Amazon Fire TV, and Roku. You can also check us out on the podcasting platforms, iTunes, Spotify, Amazon Music. We simulcast the program there, so don't miss it. Companies driven by innovative products, cutting-edge technology, and accelerating revenue are typically referred to as growth stocks. But identifying these types of companies in the crowded stock market isn't always an easy task. A pair of professionally managed growth ETFs from Advisors Asset Management are one approach designed to help financial advisors and investors sift through the clutter. Here to elaborate is Lance McGray, head of ETF product at Advisors Asset Management. Lance, thanks for joining us.
Thanks for having me, Ron.
So before we talk about AAM's newly launched growth equity ETFs, what are some of the challenges facing growth investors?
Yeah, so if you think about growth investing, many growth investors have been very handsomely rewarded over the last decade. In fact, if you think about the Russell 1000 Growth Index, it's up over 16% per annum over this time frame. So it's easily outperforming the S&P 500. Unfortunately, as you allude to, the backdrop and themes that have really fueled this growth market have been showing signs of fatigue. The AI secular growth story has really come under more scrutiny. The idea of a resilient economy is being tested, and the prospects of a higher future volatility has investors sort of contemplating, if a new playbook is needed going forward. So with that said, if we were really to pinpoint three of the most pressing challenges currently facing growth investors, I would say number one would be, mega cap concentration and rules-based and also actively managed benchmark hugging strategies. Currently the Mag 7 exposure in the S&P 500 is up over 30%. That's a 10% increase of where it was just a few years ago. So, these concentration levels are at historic highs. We don't believe that they're sustainable. And historically, when these types of concentration unwinds have occurred, it tends to lead to very, very volatile events. And number two, I would say the potential impact of rising volatility. Of course, we have, volatility around, interest rates and the economy. But let's not forget, we're also facing uncertain times around, the upcoming U.S. presidential election and other ongoing foreign conflicts. And then lastly, probably stretched valuations as well. The S&P 500 and other broad-based indices, on a forward PE basis are well over one standard deviation to their 10-year average. So again, mega cap concentration, potential impact of volatility, and stretched valuations are at the top of a lot of growth investors' minds right now.
Yeah, makes sense. Now let's focus on two potential solutions, the AAM Sawgrass U.S. Large Cap Quality Growth ETF, that's ticker symbol SAW-G, and then you've got the AAM Sawgrass U.S. Small Cap Quality Growth ETF, that's SAW-S. Both of these were recently added to your lineup at AAM, so congratulations on the launch. And both of these funds offer a unique value proposition for growth-focused equity investors. Tell us a little bit more.
Yeah, we're super excited about these products. Again, at Advisors Asset Management, we're really focusing, we're changing gears a little bit. We're focusing on active managers, the benefits of active management with the tax efficiencies of the ETF wrapper. And we're super excited about these two products. Both SAW-G and SAW-S, as we mentioned, are actively managed solutions. They're fully transparent, and they really showcase the strengths of, a successful institutional asset manager, that being Sawgrass Asset Management. Sawgrass has been around. It's a Florida-based firm. It's 100% employee owned, and it's really been specializing in growth investing since 1998. And as you would imagine, as a growth manager, Sawgrass targets companies that have potential, look for potential earnings growth. But really what separates Sawgrass from the pack in terms of their growth peers is their ability to provide reduced volatility and downside protection in a growth portfolio. And they do this by kind of focusing on three things. Number one is consistent and stable earnings growth. And you're probably saying, well, don't all growth managers look at, earnings growth? And I would say, yes, they do. But really what separates Sawgrass from the pack is they're not looking at the magnitude of these earnings growth numbers. They're really looking for consistent, stable growth. And that's some of the reasons why they're called the sleep at night manager in terms of growth products, is because they provide that stability through that consistent earnings growth. And number two, price volatility. This is another hallmark of Sawgrass and how they've been so successful over the last few decades. Their secret sauce is focusing on low volatility stocks. In fact, in addition to providing low volatility into the portfolio, low volatility stocks has actually been one of the most powerful generators of alpha in the Sawgrass solutions. And then lastly, attractive valuations. Sawgrass often refers to this as finding companies with longer runways of growth. And obviously this helps in positive growth markets. So, at the end of the day, when you add these up, you have a focus on consistent growth, you have low volatility, you have reasonable valuations, and it's quite honestly, it's just a great recipe for growth investors in this very uncertain time.
Yeah, very compelling. One last thing before you take off, Lance. How might financial advisors and investors use SAW-G and SAW-S inside a diversified portfolio?
That's a great question. And as you know, we're in front of financial advisors all the time. Sawgrass is well known in the financial advisor community. And there's really two main ways that, folks are using these two solutions, SAW-G and SAW-S. The first is, given the all-weather nature of these solutions, we see financial advisors using these solutions as sort of that U.S. core equity allocation. We talked about the concentration risk of rules-based beta solutions. These strategies offer that other alternative for growth investors to move away from those beta solutions and focus on, an active manager that has been doing this successfully for decades. So again, a core holding within that U.S. domestic equity allocation. And then secondly, for those asset managers and financial advisors that use multi-manager sleeves and things of that nature, given the fact that Sawgrass really focuses on risk management, they're able to sort of barbell this type of portfolio with more aggressive growth managers in hopes of finding, a better long-term performance and certainly risk-adjusted performance in the long run out of that growth allocation in their portfolio.
Lance, thanks for taking the time to join us, and success with the new launches.
As always, Ron, thanks for having me.
That was Lance McGray, head of ETF product at Advisors Asset Management. Quality is a factor that some stock market investors have been emphasizing. So what is quality, and how can it potentially be used to improve long-term performance returns? Here to explain is Kevin Walkush. He's a portfolio manager at Jensen Investment Management. Kevin, welcome to the program.
Great. Thanks for having me.
In recent years, quality has become a factor that some stock market investors, along with financial advisors, have emphasized in their portfolios. So what is quality, and how does Jensen Investment Management define it?
The way we think about quality, first and foremost, is sustainably high returns on capital. We look for companies that can return in excess of 15% return on equity for 10 consecutive years. So it's not an average, it's every year has to hit. With that kind of threshold, we're looking for companies that are basically delivering returns well in excess of their cost of capital, pretty much, within an entire market cycle. And typically the 10-year historically would capture that. But not only that, at the end of the day, that's just sort of an indicator of quality. For us, a quality business, then what we're looking for from a fundamental bottoms-up standpoint are companies with deep and sustainable competitive advantages that create some sort of pricing or cost advantage. We want to see companies that really have strong and diverse growth drivers that we think are very sustainable for the long term. We also see how that translates into very consistent top lines, improving profitability, and then ultimately strong free cash flow. And then typically our companies have very fortress-like balance sheets that enable them to sort of chart their own path within entire markets. We also look for strong management teams. We want to make sure they're great stewards of capital and investing first and foremost in the quality, in the competitive advantages, but even better if they can invest such that they can improve the competitive advantages. And then we're looking for strong boards that can hold management accountable for all stakeholders in the success of the business.
The Jensen Quality Growth ETF, ticker symbol JGROW, is an actively managed large cap growth fund that your firm recently launched. Congratulations. So tell us a little bit more about the fund's unique strategy and how some of those factors that you mentioned in your first response, how that comes into play, and then maybe tell us a little bit more about some of the holdings.
So the way we think about the strategy goes back since really the founding of the firm about 35 years ago. It's a concentrated high conviction strategy. By concentrated, 25 to 30 large cap names. And by high conviction, we're looking for long holding periods. So we want to look for those businesses that can deliver value ultimately into perpetuity. But what that really ends up from a portfolio average helps us find businesses that have been in the portfolio on average 7 to 8 years. So turnover is in the low teens. So a very sort of what I would call relatively tax friendly, low turnover type strategy. We're ultimately looking for, again, those businesses that can sort of deliver that sustainable long-term value. So examples would be Microsoft, Apple, and Alphabet, kind of representing our exposure to Magnificent Seven. But we also pair that with names that have delivered let's say a little bit more, or a little bit less growth or growth at a discount, but really even that much more relative stability. So that could be a name like Marsh & McLennan. That could be Procter & Gamble, Pepsi, or even Stryker within the healthcare space.
So to wrap it up, how might the Jensen Quality Growth ETF, how do you see it being possibly deployed by investors and financial advisors in a diversified portfolio?
Really depends on the risk profile of any given client. For those who are a little bit more risk averse, but still want that sort of market outperformance with lower volatility. It could be a sole position within sort of a large cap growth or growth blend. Or for those allocations where a client would like a little bit more exposure to risk, could pair us with something that's much more momentum focused within the large growth space. That from an active standpoint or even a passive standpoint.
Understood. Well, thanks again, Kevin, for joining us on today's program. Keep up the good work, and we'll catch up with you soon.
Great. Thank you so much.
Although stock market volatility has been muted for most of 2024, volatility is an ever-present phenomenon that never goes away. Likewise, it poses a unique set of financial risks for investors everywhere. So how can financial advisors and investors tame stock market volatility? Let's welcome Zach Wainwright, the CEO at Twin Oak ETF Company. Zach, great to have you here.
Ron, thank you for having me on. I'm excited to be here.
Yeah, we are too. So let's start out with talking about volatility, which has the habit of catching investors off guard. We've seen this time and time again. So what is your firm's view of volatility, and how does that fit into an investor's portfolio?
So volatility really cuts both ways for investors. It can both help and hurt an investor's return. So it's not really good or bad in general. We fundamentally believe that you can build investment strategies that seek to manage volatility, harnessing volatility when it's advantageous to achieving an investor's desired outcome, and seeking to dampen it when that makes sense. We think we can accomplish that given the institutional investor ethos that permeates everyone and everything we do at Twin Oak. In the case of our first fund, the Twin Oak Short Horizon Absolute Return ETF, it really seeks to have a low volatility to smooth out an investor's return experience over time, which we think is really core to delivering on an alternative investment solution to short duration fixed income, municipal bonds, or money market funds.
Yeah, and referring to that particular fund, that's ticker symbol TOAK. Again, that's the Twin Oak Short Horizon Absolute Return ETF. And by the way, that's your firm's very first ETF, so congratulations. Now, the fund could be a solution for investors and advisors looking for alternatives to, let's say, traditional money market and short-term bond funds. So tell us a little bit more about TOAK's strategy and holdings.
Thank you. We're very excited for our first ETF and the general roadmap of what we're building out. The origin for every product we build starts with a conversation with a client and a problem that they're trying to solve in their portfolio. In the case of TOAK, a client was looking for a substitute in their asset allocation for cash management, money market funds, T-bills, or short duration bond funds. We came back to them with this fund concept where we built a fund that targets an absolute return, a short duration, but it's managed in a way that seeks to avoid creating distributions, and so it could serve as that alternative. The underpinning of this strategy is a concept called put-call parity. It's been around since the 1960s. In the portfolio today, we're long a European call and a put on the same underlying asset with matching expirations. That means if we hold these positions through to expiration, we have the right to buy an asset at X and sell it at something greater than X. And we get to capture the spread between those two strikes. We can buy that payout structure at an attractive absolute return, and it's just that simple.
Yeah, makes sense. Thank you for that explanation. So before we let you go, what type of investor might an ETF like TOAK appeal to?
Yeah, as I mentioned, so we're in the business of solving problems for our clients. We were created by family offices to create solutions for family offices and the broader investment ecosystem. In the case of TOAK, we built it to serve as an alternative investment solution for cash, money markets, T-bills, short duration bond funds, and other similar strategies, and to do so in the simplest, cleanest form we could with an affordable fee. We're hearing from clients and prospects that this could have a pretty robust use case across all those areas. And by buying TOAK, they can focus on other parts of their portfolio where there's a higher dispersion of outcomes, rather than having to deal with rolling a bond portfolio, a T-bill ladder, or having to sift through fund offerings to maximize their short duration return pickup. We want to hear from investors on the problems that they're working on in their portfolio so we can bring our experience to solving those problems on behalf of institutions and families into their portfolio in an easy to access ETF form. And TOAK is just the first instance of that.
Well, thanks, Zach, for your insights, and congratulations again on the launch of TOAK. Keep up the good work.
Thank you so much, and thank you for having me, Ron.
Well, that does it for today's episode of First Look ETF. If you enjoyed the show, tell us in the comments section below and by hitting the like button. A cordial thanks to all of our guests, including Maital, Legum at the New York Stock Exchange. Be sure to check out etfcentral.com to learn more. I'm Ron DeLegge with ETF Guide. Thanks for watching, and we'll see you on the next episode.